The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC TV 18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pronab, and members Soumya, Kanti, Ghosh, Sajjid, Chinoy, Samiran, Chakraborty, and Sonal, Varma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajjid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Latha. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to, and hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest of the world is going to be beset with more disinflation. Think of a dam where the US puts on a tariff wall. It's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers, but the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think Latha, just to take it a little bit forward with the Sajjid's argument, yes, the growth has been weak, and continuing the same vein what Sajjid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number. but that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth actually, and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum. If you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better, possibly in the first quarter, maybe a little more in the next 3 months. But the second half is actually going to be diametrically divergent. So, in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half
Oh.
would be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth given the way things have been unfolding.
Okay. So even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Latha, I think the balance of risk, both to growth and inflation projections of the RBI, are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, the what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound, for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the kind of summer decline in inflation has been much more than what was anticipated before, and the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9, 12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad-based across cereals, as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, will probably reach somewhere around 4.5 inflation for the Jan-March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan-March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be, and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
Well, this is the thing. The point that Sajjid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
Okay. Well, I'll want more opinions on that. Let me take a quick break. We are back with more questions, also questions on liquidity and where the Reserve Bank should keep the call rate. Back in a jiffy. Welcome back to the deliberations of CNBC TV 18 Citizens Monetary Policy Committee. I have with me Chairman of our committee, Dr. Pronab and members Soumya, Kanti, Ghosh, Sajjid, Chinoy, Samiran, Chakraborty and Sonal, Varma. Gentlemen and Sonal, thank you very much for your time and for your patience. Before going to break, I asked Dr. Sen about the timing. Let me get another opinion on that. Soumya, what's your sense? Would it be better to give it earlier because you will be in time for the festive season? Or would it be better to postpone because there will be more pressure on the governor in October? The Fed may have cut. The July number looks like, it will be 1% or something inflation. There'll be more pressure on him. So is it better to push it to October?
Yeah. Thank you, Latha. I think that's a very interesting point. In fact, our July now inflation numbers are also closer to around 1.2 to 1.3%. It could be even lower. And the full year average is now tracking at 100 basis points lower than the RBI projection. Having said that, I think we need to understand that ultimately, given the inflation trajectory and given that the RBI is an inflation targeting central bank, it may have to adjust the rates in a downward direction if the forthcoming inflation numbers are an indication. But the question is that how do you time it, whether it is in August or in October? I think, in my sense, a rate cut earlier than what would have happened in October could make some sense, because in every way, if you look into the data right now, all data seems to be front loaded. If you look at the global growth numbers, they're front loaded in terms of a better number, but they are not going to deteriorate going further. Indian growth numbers will be a story of two halves, good, better now, but it may not be better in the future. Even on the inflation numbers, I think if for the assumptions in the market, the concern in the market is that the inflation numbers over the point of time, maybe over the next year, could actually inch up a little bit. But there is also uncertainty over here, and the new base which will be launched next year could actually impart a downward bias, because if the food weightage comes down and the e-commerce gets included, there is every possibility that it could be a downward adjustment in the revised inflation numbers. And also the fact that, on a lighter note, the festival season is also being front-loaded this year. It's in October rather than in November, as it happens every year. And as we have seen in the past, in 2017 also, when the festive season was earlier, there was a significant bump up in the personal loans. So, and in sense that if you cut right now, there will be a scope for the banks to adjust the rates in the downward direction, and that could actually give ample time for transmission. So from every perspective, if all data seems to be front loaded, either good or bad, and if the central bank may not take the decision to cut rates now, there is a larger probability of committing a type 2 error, which means that even if inflation continues to undershoot, you are not taking the action, because every policy we have seen that the inflation is undershooting this year, beginning from February. So if that continues, I think we may actually make a type 2 error if we are not cutting now, rather than wait for the later to cut when the numbers are out.
Okay. Okay. There is another fear which may be prying on the Reserve Bank's mind, because it's an institution with a lot of history. Uh, the, uh, they've already given a lot of liquidity and a lot of cuts. So, Dr. Sen, can that worry prey on their head? That if I have given so much and it will work its way over the next year, then at a time when inflation will be at 4.5%, you're going to have all this liquidity act, and inflation actually turns out higher. Like, you remember in 2010 to 2014, everything worked towards double-digit inflation, probably because you front-loaded too much. What's your sense? Can that be a fear?
There are two things. That can certainly be a fear. The point is, I mean, as we talked about, core inflation has been sticky for 2 years or longer, actually. That's not been changing, right? So all the variations that you get are in those components of the CPI, which are inherently transient in nature. Now, the real question is that it's not just what the RBI feels may happen in a forward-looking sense a year from today. It's also important for the RBI to be seen to be doing something when the objective conditions of the world change. Now, my problem is that if we actually front load and then something goes off the cliff later, then we may not have any other arrows in the quiver.
Got it.
Right? The RBI will look toothless.
Okay.
And it's the image of the RBI which the RBI can and will, I think, try to protect.
Okay. Fair. Yeah, they should be seen to be doing something if things look very bad in September and they need that ammunition. Samiran, let me come to liquidity, the elephant in the room. Do you expect Reserve Bank to keep call rates at the lower bound? That is, if the rate is 5/4, suppose it's a pause, then will they keep it at 5/4? And if they do cut, will they keep call at 5%?
View, since RBI has now changed the stance from accommodative to neutral, it will be more consistent if, in the neutral stance, the sanctity of the monetary policy operating procedure is maintained, and the weighted average call rate is kept closer to the repo rate rather than closer to the SDF. Now, one way to get around this is to do the rate cut. We have been talking about that if you do the rate cut, then effectively the weighted average call rate falls down to 5/4 rather than staying at 5/2. So rather than doing this somewhat stealth method of keeping the rate 25 basis point lower than repo through liquidity operations, it's probably at this juncture in a neutral stance better do an explicit rate cut and keep the overnight rate at 5/4 is what our view will be. Anyway, we'll all be looking forward to that new liquidity management framework suggestions to figure out whether there is any significant change to the current operating procedure that has been suggested.
Okay. Well, actually, on liquidity, some more opinion from you, Sajjid. Do you think continued higher liquidity will be needed to help credit offtake?
There'll be a temptation for that, Latha, because there's somehow this belief in the market that when you inject a lot of durable liquidity and banks are lending to the RBI, every day, whether it's a VRRR or in the STF, that somehow behaviorally that induces banks to boost credit growth, to lower deposit rates, cut lending rates, and boost credit growth. So we do
Because it's a loss, that's a fair expectation.
Yes.
It's a loss when you put it to Reserve Bank. You might as well give it to an NBFC.
It's a fair expectation. The question is, does it stand the scrutiny of data? And so we looked at this, very exhaustively for the last 10 years. And what we find is that, theoretically, there should be two channels at which liquidity impacts credit growth. One is the interest rate channel. And Samiran alluded to that when you inject a lot of liquidity, you push the call money rate down to the bottom of the corridor, and that will clearly have some impact on lending rates. And I agree with Samiran, while that's tempting to say, let me do some stealth easing, in the wake of so much global uncertainty. If your stance is neutral and there has to be sanctity to that rate, you need to move that rate back to the policy rate. The question, therefore, is, well, what if I add more durable liquidity, keep call rates at the policy rate? Will the injection of more durable liquidity, increase credit growth? And what we find is there is no evidence for that. Okay. It's called the credit transmission channel. We find no evidence that beyond affecting the call rate, higher quantums of durable liquidity either boost deposit growth or boost lending growth. So I think the incremental efficacy of that is extremely limited.
Okay. Well, let's see. Even in the last cycle, the one I remember, 2004, it was only after the rates started rising that credit offtake went through the roof. But situations are very
lending
different.
Rates and credit growth. Yeah.
Yeah. Sonal, out of time, but very quickly, will the rupee be a worry at all? I mean, we've suddenly seen the impact of the trade issues on the rupee. Will Reserve Bank worry we can't cut too much, rupee under tension?
Should not be, Latha. I think obviously we need to wait for what this Russian penalty is and what that ultimately means. So that's something to monitor going forward. We have sufficient FX reserves to manage volatility. And importantly, inflation is below target. So any sort of imported inflationary pass-through will more than be offset by the disinflation we are seeing on food and core, such that overall inflation will still undershoot not just 4%, but the new projections and potentially actually undershoot 2%. So should not be a constraint in our view.
Oh, okay. Well, thanks a lot for many-sided discussion. Please take up your voting pads. The first question that you have to vote on, what will the MPC do to the repo rate on August 6th? Can I start with Samiran?
We are expecting a 25 basis point repo rate cut in the August meeting.
Okay, cut. Soumya?
We are expecting a 25 basis point cut.
Oh, that's two cuts. Sonal?
We think the MPC will hold rates this time, but a dovish hold.
Okay. Hold or a pause. Sajjid, pause or cut?
It will be a pause.
Okay. Dr. Sen, your team is divided 2-2. Which way do you tilt?
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying. Finally, if you include an action on August 6th, how many rate cuts do you see in 2025? Samiran?
Only 25 basis point.
Okay. One cut only, that which you're expecting on August 6th. Soumya?
We are also looking at one more cut, 25 only.
Sonal?
50 basis point more.
Okay. Again, there is a dissent here. Sajjid?
I would say either 0 or 25 basis points.
No, I'll have to go with 25. No, I can't take either or. I'll take 25. Dr. Sen?
On this again, I will go with Sonal.
Okay.
Delay and when you do it, have a 50 basis points cut.
Oh, 50. Okay. I think you would want a 50, is it, sir?
Yes.
Okay. So it's actually equally divided, almost 3:2 in favor of a 25 basis cut. Have to wrap up on this edition of the Citizens Monetary Policy Committee deliberations. Thank you very much, members, for your insights.